guys. Thank you guys who are online for your patience here. We went over on the first seminar, so we'll get right back into it. And we'll talk about some investment side of things here. What we've got going here is I'll be teaching about the Austin, Texas market, but I'll also be teaching out of The Millionaire Real Estate Investor, which is a book that was written by Gary Keller. He's the chairman of the board of Keller Williams Realty, which is will be the largest real estate company by, I believe, next year with over 80,000 agents, and that's who I'm with, is with Keller Williams. And so this book is an awesome resource to be able to understand taking it from 0 to 100 on how to become a real estate investor. So I'll be teaching out of that, and I do have a course coming up that I'll also teach the real estate investing side of things, called a Real Estate Investor Crash Course. And I'll also be teaching out of this book called Flip, which is how to flip properties. And there's a third book that just came out, and I didn't get it yet. It's a national bestseller, and it just came out, called Hold, which is the third part in this series here. And I'm going to give you I'm going to refer back to these books. But I want to give you an opportunity to join me if you're interested in becoming a real estate investor. It's going to be Investor Crash Course starting in November 7th at 1 p.m. It's a webinar-based series, and there's a form here that we're going to go over that you can look at. Once again, we're here to help you purchase real estate here in the Austin area or to purchase your first home. So I appreciate you guys staying for those that are more on the first-time home buying side of things. I think you're still going to find this is going to be really valuable for you as you become an investor. Wow, people are throwing money at me.
Or is he paying you for the first part?
Thanks, Jerry. All right, so we're going to get started here. All right, so those that are just joined us on the live webinar, I'm Kenn Renner, real estate broker. Over 30 years of experience in the real estate industry. Got my first license when I was 1983. I've sold over $250 million in real estate in the last 30 years and $100 million in the last 6 years. You may have seen me on HGTV, and I'm also a national speaker, spoke around the nation about real estate and also several other subjects, including goal setting and time management. If you're looking for a speaker, I'm available. You've got my contact information. It's ken@buyaustin.com. That's KENN @buyaustin.com. I'll travel to speak. That's my passion. And also, my phone number is 512-423-5626. All right. Enough of the intro. These are my latest two books, and Home Buying Secrets, which I just gave away to everybody here that came live. Anybody that's streaming on the seminar, I can send you an ebook of this if you'd like. And if you'd like a hard copy, I can go ahead and also send you a hard copy. All right, I'll be teaching out of the Millionaire Real Estate Investor Crash Course. And once again, that's a 10-week training that starts in November 7th. And you get all of these books: Flip, Power Goals, my book, as well as Millionaire Real Estate Investor. But I'm going to teach you how to acquire property in this new millennium. Okay, so once again, we found the Austin, Texas region #1 job growth in the nation. A lot different than it was over the years. A lot of different cities that can't show you this kind of growth. This is 2002. This is 2012. Big difference. So Austin is cash flow city. We have the highest rents that we've ever had, and we've had the lowest interest rates in history. So opportunities where wisdom meets preparedness. I just came up with that line because I think it's important. No time in history could it be a better time to buy real estate. Investment sales actually accounted for 27% of all new and existing home sales in 2011. Over a quarter of the market is investors. Now, why would investors be buying? Because of high rents, low prices, opportunity in foreclosures and REOs, and because there's a lot of population that is renting. Warren Buffett once again said that along with equity, single-family homes are a very attractive investment right now. If held for a long period of time and purchased at low rates, Buffett says houses are even better than stocks. And Buffett said that he'd buy up a couple 100,000 single-family homes if it were practical to do so. So we want to look at the stock market. Too bad my stock market guy that just left, I was really happy about that. This looks more like, this was the last 5 days, I believe, and it's gone up from there, but it looks more like a heart monitor to me. It's like, it's a heart attack. How can I keep track? How can I depend on this? It's like, it's exciting that we're at the highest point of the stock market, but I'm going to encourage you to maybe take some of that stock market money or some of the self-directed IRA money and put it in solid assets like real estate. Here is the 5-year average. Here's an interesting chart for the last 5 years. I mean, I look back here and I'm saying, wow, after 5 years, it's only down 4.82%. So this is the Dow Jones Industrial Average. So over 5 years, this is where we're at after all that, after all that time. And yeah, I know, yeah, right, okay. But good news is it's up now, and so you could take some of that money before one of these things happen. Now, we have a lot of dynamics. I'm not a financial planner expert. No one can predict the market. My financial planner told everybody to sell around this right here recently. It's just a matter of your tolerance. But I can't handle it going like this. And with all the economic turmoil and with the oil thing and all that, we don't know. We have no control over the stock market. As opposed to real estate investments, we do have some. We can actually go visit it. It'll never go we actually have control over what happens with it. We can buy it, sell it, finance it, refinance it, pull cash out, lease it out. So someone else makes the payments in real estate and eventually become free and clear. And that's where it gets lucrative. Roy Rogers said, find out where people are moving and buy land. And I'm saying buy property because land doesn't give you any income. So we're looking at find out where people are moving, which they're moving to Austin. And they tend to follow historical patterns. Real estate tends to follow historic patterns. The stock market turns on a dime, as you know. But the real estate market is more like a big ship. It doesn't make quick turns, and so it's more predictable. Here's an interesting chart that we came up with. This is the difference between Texas and California. We can pretty much say Texas and the coast. Is that we have had a counter cycle that's been going on. My father, who's a real estate attorney, taught me this so many years ago. Is that there are different parts of the country on different real estate cycles. And so we can go all the way back to 80s and even into the 70s, and we find that these patterns have consistently been through history, where eventually actually real estate values do go up over time. That's just been a historical thing. But they go different in different areas. And what I've noticed here is that when I moved to Austin, Texas in 1993, I predicted that I knew that because the job market and the affordability in California on this blue line here had to go down, because it's pretty easy when we're only at 3%, 8% affordability factor, it's going to go down. So certainly all the way through 97, the values of property go. So I moved to Austin here, and I purchased a property here, and I purchased a bunch of properties, and I rode that up until about 2000. And what happened in 2000 is we had the dot-com bust, and Dell started laying off employees. So what happened is the stock market had a difficult time. So what happened here is it leveled out during the early 2000s. Well, what happened in the other parts of the country, like California and the coast and Phoenix and all that, drove up prices way beyond where they were supposed to go. And guess what happened? There's usually 7 to 10 year cycles, but what happened here is the easy, greasy money that the mortgage companies, shame on you, Mark, no, I'm just kidding. The easy, greasy money that the mortgage companies were allowing pushed this cycle another 2 years further, even more overheated than it's supposed to have been. So we've had obviously a huge correction in the California markets, and we don't know how long it's going to stay at the bottom. I hear they're doing pretty well in the low-end market. But we've always seen consistent growth in the Austin area, and I'm going to show you that here. Once again, here's my little pitch, Millionaire Real Estate Investor Crash Course. I'll be sending you guys an email on this. Let me see if I get my charts here. Where's my charts? Here we go. Let's take a look here. Let's get to the point here. Now, Austin median home prices. I showed this to you guys this is going back to 1990. We're at the highest median price we've ever had, but it's always going to continue to go up. Like the gentleman at the break that we said, we have a problem with lack of inventory, lack of laborers to build these properties, lack of supply of building materials, and lack of developed land. The economist Jim Gaines from the Texas A&M Research Center said that we were looking at pretty much a 5% increase over the next several years in values here in the Austin area, 5% per year. Can't ever predict inflation, but that's what we're looking at. So For those that are out of state, those that are here, we know we're the capital of Texas. We got a UT game going today. We have the new Apple computer facility with 3,000 new jobs coming to town. We have the Formula One race next month, which is going to be, how much is that impact going to be? $500 million impact or something like that?
$500 million.
$500 million impact for one race, but the track is there, so we'll probably get another race in 2017 or whatever it is. Live music capital of the world, South by Southwest. Hollywood is moving here. We call it the East Coast. We've got major employers, the biggest one being the University of Texas, right? And then we've got federal government and state, IBM, Samsung, Freescale. It's a high-tech area. Of course, Whole Foods, one of the poster childs. What's that?
Did GM bring?
GM's bringing. What's the GM bringing? How are they? They're bringing they're bringing a technology center here. GM's coming. Thank you for reminding me of that. But anyways, jobs are moving here.
You got Apple up there?
Yeah, Apple was already up there. 3,000 new jobs, right up in our neck of the woods. Let me tell you what happened in the previous years, the previous boom and bust here. In 04 to 07, there was a rush on residential housing, which started in California because the prices were going up so fast. 17% in 1 quarter, I remember back in with that chart that I showed you. 1 quarter. I started going to California in 2004, 2005 saying, you better get your money out of this equity that's here because eventually it's going to evaporate. And they were saying, no, it's crazy. Why would I invest anywhere else if I'm getting 17% appreciation every quarter? I said, it will change. It will turn the corner. And about 500 people did buy homes for me over that period of time and got their money out of California and did what we call a 1031 exchange, which allowed them to get their money out tax deferred and bought property here. I think you guys did the same thing. You got out of the got your money while it was still, your equity out while it was still there, because now it's evaporated. And so there was a feeding frenzy, started in California, then went to the Inland Empire, and then it went to, and it was also, Florida was over here for the East Coast people, and then Arizona was the next, or no, Vegas was the next place. Everybody was rushing there, and they were buying homes. And then it was Phoenix. Everybody was buying homes in Phoenix, and they were using the easy, greasy money that the mortgage companies were just handing out. And they were, and that's what happened in 04, 07. It was irresponsible, but it because it was the lenders that were allowing it to happen, which was driving up prices. It would not based on jobs and income, but based on speculation, and that's a dangerous place to be. And I can tell you, guess what? It wasn't really the mortgage companies; it was Wall Street, because Wall Street has mortgage-backed securities. You can't have mortgages to be able to provide to the next person without having a place for those mortgages to be sold, and they were sold as mortgage-backed securities. Then those were sold off into you know the story. They were sold off into IRAs and all kinds of stuff worldwide. So even I saw on CNN that one of the Norway, a city in Norway, almost went bankrupt from the mortgage-backed securities that they were buying. So it was really a feeding frenzy on properties, irresponsible, not based on employment and job growth, but based on greed. Okay, so an easy money ended in 2007. We know what happened, and it turned around, Mark, as quickly as you know, on a dime. I remember Countrywide Home Loans were funding loans, $1 million, Nina, no income, no asset, and then the next day they were shut. There were no more loans, and so we're still feeling that. Now I sold a whole bunch of investment properties here in Austin. And our investors have done quite well, because if you saw the charts, then you'll see the charts that were going up. Now, they may have not gotten a huge amount of appreciation over the last 5 years, but it was flat. In other words, we didn't lose 30%, which have wiped out their whole investment. So what happened, though, was we had a glut of rental property, because I wasn't the only one selling rental properties in Austin. There were a lot of realtors. So I put 500 on the ground, but there was probably quite a bit more than that were. So we had too many rentals available for the available inventory of renters. And so therefore we couldn't have a price to go up. Now it was absorbed over time. I mean, I think Round Rock East at one time, one section of the MLS had 220 rentals. Pflugerville had 170 rentals. I mean, it was way too much inventory of rentals. So we had competition for the rent values. Now, over the years, because now investors could not borrow the money like they were able to, they took a lot of people out of the market, including myself, who's bought and sold. Well, when the mortgage industry got shut down, it then shut down my ability to borrow money. So I was one of those investors that would have bought and sold responsibly, putting lots of people to work. I mean, you think about the landscapers and the window covering people and all this, putting lots of, it was an economy, a huge economy that we were driving by buying and selling, buying and selling. Well, the lender said no more. If you own more than five or 10 properties, we're not gonna lend to you. I know you've been responsible and got perfect credit, but we're not gonna loan to you. I don't care if you have $1 million in the bank, we're not gonna loan to you. And that was the mentality of these banks. So investors that used to buy, now that we're shut out of the market, they started selling their properties one by one. In other words, for whatever reason, the investors that bought these properties would sell them for getting married, getting a divorce. Maybe they had some property in Florida or Arizona that was a big drain on them and they needed some cash. Over the years, they started selling these properties from 07 to 012. They started selling them one by one. Now what happens, our supply of rental properties have dropped dramatically. I mean, an area of Avery Ranch, which is one of my top areas that I have a bunch of rentals in, at 4,400 homes, and we have 8 properties for lease in that area.
Wow.
8 properties for lease. So what's happened is we've seen that's why we've seen our rents increase as much as 20% in the last year in certain areas. And so if those that are on the webcast, if you have rental properties, especially in Austin, you need to contact me when it comes time to renew your leases, because a lot of even the property management companies aren't raising it up as the rents as fast as the market has allowed for the absorption. So our rents have gone up, and they're going to continue to go up. We're at 97% occupancy in Austin. 97% my property manager who manages 600 properties in Austin is at 97.7% occupancy in the rental properties. So not only the availability of rental homes has gone way down, you don't have a whole contingent of a lot of investors coming in and buying them like they are. They have started coming. And guess what? A lot of them are paying cash. A lot of these investors, Linda's going to go show a property to a guy out of Corpus Christi today that's paying cash for a house for his sons to go to UT. And he's got an extra little bedroom for him and his wife to come and go to South by Southwest or whatever that he's reserving for himself. So they are coming, and a lot of them are paying cash. And then along with that low end being bought up, you've got the first time home buyers, which was the first session in this course here today, are also buying up because the low rates, the high rents, they want to get out of the rental rat race. So they're buying up. If they can qualify, they're buying. So there's also a contingent of people that are forced to rent. They're forced to rent because they may have had a short sale in California or Arizona, and now they can't buy for 3 years. And so those are some of my favorite tenants, right, George? The ones that came from California, they both got high-paying jobs. They've got perfect credit otherwise, except that they had to let that short sale property go back east or back out west. And so they're stuck in my rental for 3 or 4 years, paying whatever rent I really want to charge them because they can't buy. So a lot of people are forced to rent. They're also coming here to take the jobs. And we talked about the U-Hauls. 3 times more expensive to get a U-Haul out of California or out of New York than it is to go the other way, because there's so many people moving here. Lack of lots, lack of labor, lack of materials, current rental shortage, all driving prices up. The home that I sold in Dyer Creek closed last month. It was Tim Scoville from Polycom. Closed. He bought a house in Dyer Creek, which is in Round Rock, and he bought it for $230, and he just said that they're going for $249.9. Same house that he bought, and he says the houses across the street and down the street, there's slabs there that aren't being built on because there's no labor, there's no framers. We have such a shortage of framers, so those lots are just sitting there waiting for framers to get to them. And this is the reality where we're at in Austin. This chart, when I send you this chart on your PowerPoint, is worth looking at. You can't read it here, but I'm going to send you this. It's worth looking at. It's the blue chart, and it was something that Mary and I put together. It shows the every area of Austin and the rental increases over the last year to 5 years. So don't worry about that. I'll send you the PowerPoint. You can get it. Anybody that did the email to me, I'll go ahead and send it to you. Here's the Austin annual growth for employment, outpacing Texas and outpacing the nation. Number 1 in the nation. Jobs is what the first thing you look for in real estate investing. Where are the jobs? More jobs. This is from the Texas A&M Research Center, so I'm not making this stuff up. Population growth, 2000 to 2030. Can you believe that we're going to have, in Texas, we're going to double our population? Well, no, almost triple the population. In Austin, we're now at about, and the MSA, that's the 3 counties, we're looking at 1.7 million people. And by 2020, we're going to have we're going to have another 500,000 people moving here. What are they going to do? Where are they going to live? They're going to rent first. So and we have a shortage of rentals right now. With all these people moving here, where are they going to go? And we're not building them fast enough. This is a very interesting chart because this is our population growth. Obviously, this is where I was born. I'm a baby boomer at the very tail end, and then we have the Gen X, and then we have, guess what? The largest population is the Gen Y. That's the 16 to 34 right now. That's the largest population group in Austin. And Gen Y, this echo boomer, they are right now more apt to rent and have that freestyle lifestyle where they're not tied down to owning because they're not ready to start a family as much. They'd rather live maybe a little closer into town, and they're willing to live in smaller spaces. And they want to rent to have the freedom because they're not quite ready to start a family. The largest percentage of these people right here are going to become they're going to be renters, which means that we're going to have more supply of renters than we're going to have of home buyers. Here's another chart. Look at this. This is U.S. homeownership nationwide. If you look here, we have U.S. ownership rate, current rate. Well, Jim Gaines, the economist for Texas A&M, said that this should be really the place where 65%, 64% should be about where home ownership should be. The other 35% should be renting. Well, of course, in 96, 97, when we had all the reforms and everybody was supposed to get a home back in the days of the administrations, it got way out of hand and we ended up almost 70%. In other words, this was 70% of the population were homeowners. And the reason why I said it was out of hand is because these people were getting zero down, no qualifying, bad credit, no history of making their payments. Adjustable rate loans with balloon payments, and because that's the mortgage products that were out there. And so this is what happened, and now we're seeing homeownership get back down. Guess where all these the people that used to own homes, what they're going to have to do? They're going to rent. Then we take a look at this chart here. Here is the chart for Austin. Looks a little bit different than that stock market chart, doesn't it? Stock market chart is like this, and we just don't know where it's going to go. I'm not against stocks. Warren Buffett's done pretty well, but this is the Austin. This is all the way back to 1995, and this goes all the way back to 1990. You've seen this chart already. Had some leveling out here, but over the time, and this is where we're headed. Highest that we've had in 2011 is highest, and we're going to continue with 5% increases is what Jim Gaines is predicting. And the great chart there, another 5% appreciation level. With the lowest rates in history and buying a property that has this direction, I don't think it can go wrong. Look at our months of inventory. Down to July of 2012, we were down to 4 months of inventory available. So it's very low. It's a seller's market. But fortunately, like we said, summertime it got even lower. It was down in some areas down to those 2 months supply. And in rentals, guess what? We have a half month supply. We're back up to about a 1 month supply. It's basically a housing shortage, especially in the low end. So you've seen this chart, and this is the chart that over the years has helped me sell a lot of properties to a lot of people by recognizing the cycles and the counter cycles. All right, for those that are not in Austin or on live stream, I just wanted to show you our beautiful city. Beautiful capital is built 4 feet taller than the U.S. Capitol. Everything's bigger in Texas, right? The high-tech industry is exploding. We have our $3 billion in toll roads. They just raised the speed limit to what? 85. 85. Now, I know in California. That's Formula One. This thing. So what has happened is it's brought these toll roads have actually brought the suburbs into town. Can you imagine being able to go 12 miles out in the suburbs on a toll road that's 85 miles an hour, and with very little traffic? Yes.
Are they all 85?
Well, I know 75 on 45, and then there's 130's got. I haven't seen the 80 mile an hour because it's also South Austin. It's the new section that they're building further south, but they raised it to 85, which means we're going to be flying down at 90, right? It's just like a 405 freeway.
120.
Yeah. Yeah, so we've got the infrastructure, great lifestyle. It's Terra Vista Golf Course. By the way, I have a home in this area that I think would be great for an investor, $175,000, where everything else is up over 200. Rent for all kinds of infrastructure around this golf course, including hospitals, outlet malls, colleges, universities, all that came into play in the last 7 years. Avery Ranch is one of my favorite places to hang out. I own several rental properties, and many of my investors have bought right here in Avery Ranch because it's a proven subdivision, and there is no other Avery Ranch coming. In other words, you don't see anybody building any more golf courses. So it's kind of like the last of the Austin city limits properties that are being of this caliber. So here's a view from the Avery Ranch Country Club. It's no membership to join. It's a public golf course. Nice day, lifestyle, living the life. And I'm not just the Avery Ranch guy. I sell homes all the way down as far as San Marcos, all the way up to Temple. So just don't pigeonhole me. And I sell homes all the way as low as, what was our lowest sale last month? Was 120,000 we just sold. And I sold as high as 600,000. So I sell in all price ranges, whatever meets your needs. And then this Lake Travis, just outside of Austin, 14 miles out of Austin, and we just live the lifestyle. Right, everybody in Austin? You like being here? Yay! Right, Sherry? Where'd you move from, Sherry?
Detroit.
Detroit. Wow.
Detroit to Lakeway.
Yeah, exciting things in Detroit.
Oh, is it Detroit you can share with us? The yin and the yang?
The Detroit, they said that you could buy a house for $1 in Detroit. Yeah.
Wow.
Yeah, because it costs more to tear it down than it is just to sell it for $1.
I have an investing theory in Detroit.
So yeah, our marinas and everything, and so I just wanted to show the lifestyle, the lake lifestyle that we have out here for our guests. Okay, here's some examples of investment properties. This one I used to own. It's about $175,000 property. The rents right now for that will be about $1,550. There's the interior, shows really nice. This house right here is $120,000, and it will rent for about $1,200. In fact, we've got 2 more of these coming up on the same street, and they're about 1,200 square feet. They're easy to rent out, and they'll rent for about $1,200. So you see those numbers work pretty well.
Where was this at?
This is in a Cambridge Heights, a subdivision in Pflugerville, and it's rents for $1,200, and your price is $120. Remember, the payment schedule is about $7.77 per thousand. And I've got some performance on here I'll show you after I get through the property so you can kind of see. This is your typical Avery Ranch rental that we're getting. For years, George and I were getting $1,395 for this house during the last few years. We're now getting $1,600 to $1,700 for this house. And we just closed on one of these we just sold one for $196. So the payments the numbers work really well on that. Same model, just a different structure, different exterior. This is a duplex that we've got out in Lakeway. And one of the things that we get a lot of questions about is, should I buy duplexes? And the answer is yes and no. There's some advantages buying duplexes and there's some disadvantages. For the most part, we're not a big city of duplexes where we have a lot of duplexes available. Most of them were built in the 80s. So, and they're really not building anymore. There's no zoning for them. So one of the things that you have to make sure is when you're buying a duplex is there have been certain things been taken care of on the properties. In other words, does it have an original roof? Does it have original AC? Does it have original appliances? Because if it hasn't been replaced, it's going to be a capital expense that you're going to have to take care of. And most of them were in the 80s when they were built, early 80s. So, and one of the things too is investors are willing to pay more for duplexes, so they drive the prices up higher, which is great for those that own duplexes. They drive it higher than if you bought 2 houses next to each other, believe it or not. So the good news for those that own duplexes, you should be getting a premium. George just put one on the market for $177 down in South Austin. 2 ones on each side, right? Okay. And about $800 each side, so it's about 1%. Yeah.
880 on one side.
880 on one side, and the other side will probably go to 880. So you're almost 1,800. So duplexes still are investors have a big hunger for them. You just got to make sure that you get one that doesn't have a lot of capital expenditures that need to be replaced. Don't really have a lot of fourplexes at all. Fourplexes, for what is, you can find them, but they're usually in beat up, tough areas. Okay, another big house, that gets to get bigger and bigger, and this house is in in Round Rock, and it rents for its value is about $220,000, and rents for about $2,400. This house we have listed here is on Valley Clark, and it's the home that was $269,000, right, Mary, and which should rent for about $2,500, $2,400 to $2,500. I'll be holding that open house tomorrow on Avery Ranch, so come up and visit with me, and I'll send you all out an address to this house. If you want to come talk with me in the house, we'll talk all about real estate. Okay, here's a sample pro forma with 20% down. You're looking about $26,000 down on the 130 purchase. Cash to close is about $29,000 after closing costs. You can negotiate the seller to pay those closing costs. The loan amount's about $104,000. Now, I have 4.25 on here. This is my old slide. What's an investment property?
Probably high threes right now.
Okay, Mark Hairston from Mortgage IQ saying it's going to be about the high threes on
Yeah,
this
single
investment
family.
property. Single family.
Investment.
So, what we're doing, George and we have some properties that we're selling. Why would I sell an investment property? That's such a good potential. Well, because I have 7% interest rate that I got back 6-8 years ago. And I can go buy now with 3 3.5%. So I'm paying too much interest, and that's where a lot of these investment properties are. People got tenants in place. We call them turnkey investments. I have about a half dozen of those, actually about a dozen, that I've already got tenants in place. They're already managed. They're already got people. It's all turnkey, but they've got a lease in it, so you can't sell it to an owner occupant. We sell that to an investor who now can get those low interest rates, and it relieves the current investor of his 7 or 8% mortgage that he has on it. So anyways, back to this, we're looking at cash to close, $229,900, $104,000 loan amount, and we're looking at a total payment of $832 a month. I would highly recommend management. You can self-manage if you want, save this money hopefully if you're local, but if you're out somewhere else, out of state, then you definitely want to have management. So our total payment with management is $946, and right now we're getting between $1,275 and $1,375 rent. Now obviously there's some other factors that we want to put in here, which would be vacancy factors, and you got to take the fact that you're going to have a vacancy every once in a while. We're figuring about 1 month vacancy out of every 2 years is our ballpark. And then there's some leasing fees that would be about the same, about a 1 month out of every 24 months. But we have some pro formas that we have with our real estate investment software that comes with my real estate investor crash course that allows you to plug those numbers in and run those scenarios, so you see basically how you can go with the retirement strategy based on each one of these properties at this kind of payment rate. Here's $150,000. You're looking at about $33,009 to get in with 20% down, owing about $120. Payment total is $950, and we're looking at about $1,071 PITI with management, and you're looking at $1,350 to $1,500 rent right now. So if you can get that 1% per month rent, that's a really good return, especially with the low payments. I mean, you're just talking positive cash flow. Most of my clients right now are high-tech employees, either in-state or out-of-state, that have a pretty full 401k, that want to diversify with either their self-directed IRA or retirement and get some real estate where they actually get positive cash flow and also the potential appreciation that's going out. And they're very happy, and they're buying more. They start off with the 1 because it's their learning curve, and that's where I teach people through. I give these books, this whole series of books away when I get with a client as far as during the real estate investor crash course, and I teach them exactly what they're going to be getting into, and it takes their fear away of purchasing a home or their investment property, and then they buy the next one, and then they buy the next one, and we go on as many as 10 properties over 10 years. And that will give you over 20 years financial freedom if you do it right. Here's a $175,000 purchase, about $40,000 to get in. And you're looking at about $1,099 payment, $1,227 is your management and payment, and you're looking at about $1,450 to $1,600 right now in rent. So you have positive cash flow. What does that work out to be? That's about, $200 to $300 to $400 positive. Now, what you do is you take this that if you don't need the money, take that money and put it back on the mortgage and pay the mortgage off quicker, okay? And one thing we haven't talked about here is that everything involved with the house is a tax deduction. So everything including the mortgage payment, the expenses, and the management, and anything that you have to fix up, everything associated with that is a tax deduction. So you get this tax deduction. Now, not only is it a tax deduction, but you also get what's called depreciation. That's a paper write-off that the government allows to write off over 27 and a half years. The value of the property, the building itself, divided by 27 and a half years. I'll explain that to you in a second. Here's another down payment of a $200,000 property, $40,000 down payment, $44,000 to close, $160 loan amount, $1382 payment, and you're getting between $1,550 and $1,800 rent. So that works out pretty well as far as positive cash flow. Okay, that's what I teach in my Investor Crash Course, so it's investorcrashcourse.com, and I'll be getting to you in a second where we're going to be going with this. All right. About being an investor, one of the great things is that you enjoy leverage and appreciation, depending on where you're buying. I know even in California, we're actually seeing that the bottom end is starting to come back up. We're seeing multiple opportunities. People are so with so much multiple offers going on in areas of California, they get frustrated, and then they end up not buying any rental property because they're being bid out by cash buyers or whatever. So that's what I'm saying is the opportunity is here for those in California. Buy here, buy your investment property here, where you're not in this bidding war situation. One of the things I talked about with you guys yesterday was avoiding the stepped up basis, avoiding taxes through the stepped up basis. What that means is, as the property gets more and more value, and let's say you bought it for $100,000, or like my dad paid $17,000 for a property, and now it's worth $1 million in San Mateo, California, after 40 years. If he sold it the day before he died, and then he would have paid a capital gains on that. If he heirs it to his kids, they get what's called a stepped-up basis, which means that the government says now, rather than you paying all that gain on the increase of the value of the property, the son or daughter now gets it at the basis now becomes that $1 million of what it's worth. It's only, and I'm not a CPA, I'm not an attorney, so you definitely counsel with your certified financial planner and your attorney and your CPA about this, because I'm not authorized to give tax advice, but test them on this theory. Because the stepped-up basis is big. It's a great business, I think, for young people, and we've had several people in our office recently, and I think Jerry's even thinking about getting the next generation into buying and selling and building a portfolio of properties based on the dynamics. It's a great business for financial freedom, great business to get your kids into. So let's talk a little bit about depreciation. It's a passive paper write-off, and I'm going to give you some secrets that maybe you didn't know about. And once again, check and confirm this with an accountant, because I'm not a CPA. But you can write off depreciation based on the depreciation write-off is, let's say your property is the rents are equaling the value of the property. When the year's over, the expenses equal the value, and so it's basically a break even. Well, the property also has what's called depreciation the government allows you to take, which means the value of the building divided by 27 and a half years is now your passive paper write-off. It's a paper write-off against the expenses of the property, if there were any. Okay, so that means that for a $150,000 building, it's about $7,500 paper write-off. You can use that against, depending on how much income you have, you can actually roll that over onto the front side of your tax returns and shelter your ordinary income. Once again, check with the CPA, because it depends on what tax bracket you're in. It depends on what other things you've got going on. There's limitations based on income. This is perfect for somebody making $100,000 a year or less. They can write up to $25,000 passively. So like I said, these properties that break even have these $7,500 tax break every year because of the depreciation, is a paper write-off off of your income up to $25,000 a year for those making less than $100,000. For those that are making over $150,000, they can't take any of that deduction. So what it does, it stores up in the property. This paper write-off stores up in the property all over the years of ownership. And this is where we get into the real estate, single-family real estate retirement strategy. And what that is buying properties during your income producing years where you don't necessarily need the write-offs, but allowing these properties to build up depreciation, which is stored in the property. So after 30 years or 20 years, when that property is paid off and you're not working so hard because you're in retirement, the property will now have all this stored up depreciation. When that loan's paid off, you're gonna have all this positive cash flow, right? Because there's no loan anymore and your rents have gone way up. Now it shelters any of the income that is now generated by these single family homes. That depreciation shelters, so it's like having sheltered tax-free money. Now, there's another way for you to become and be able to use this passive write-off that so many people enjoy. I haven't paid taxes in a long time because I have so much property that it wipes out my taxable income. And you can become a real estate professional as long as you meet the IRS guidelines, or a spouse, if you're married, can become a real estate professional. Doesn't mean having a real estate license. It just means following the guidelines that the IRS have, which is 750 real estate hours annually and 50% of your business activities have to be in real estate. And you're going to have to consult with an accountant and a CPA on this because you have to do it right. But this allows somebody who has a husband or wife who's making a ton of money in their high-tech career or whatever, like a doctor or something like that, and making way too much, and the wife or husband is at home watching the kids. They can become a real estate professional, and allows this depreciation that would normally be only stored up in the property to now shelter his ordinary income now rather than waiting till later. Does this make sense at all? Okay, so if you've got a high income earner and you've got somebody who, if you want to get into real estate investing and you have a passion for it, get the spouse to become what we call a real estate professional, and they can now take that passive depreciation and shelter the doctor or the high-tech employee's income now rather than waiting till retirement. So it's a huge loophole in the law, and you've probably not heard of it, but it's there. And be glad to talk with you and your accountant, your financial planner, when the time comes if you want to use this. The other strategy with investment property is what we call the 1031 tax deferred exchange. And that allows you to sell property, but exchange it for equal or greater property without having a taxable event. If you sell property currently and you have a gain on it as an investment property, not the primary residence, but if you have an investment property and you sell it and you just cash out, any capital gain that you have will be charged at 15%. Plus you'll have what we call depreciation recapture. With the 1031 exchange, it allows you to defer into equal or greater values into more property, but not have a taxable event. It's deferred into the next property. And this is where we had the gal from California who sold her fourplex in California, right in Huntington Beach, and then she bought 10 single-family homes here with that fourplex. Now, then she probably would have been really wise at that time to exchange, and she did through an exchange, so she didn't have any taxable event. If she's really wise and played the market right, she should have 1031 all those back into California during its recession around 97, 98, rode that wave up, and then tax deferred them back into Texas. And she would have been, and that's what we talk about, is that all the way you're deferring your taxes without paying. And so there's certain rules involved in it, and I'll be glad to talk to you about that, about how that works. So we've got a lot of people that have homes. We have clients of Linda's that have free and clear property in California that they've had in their family since the 70s. They can 1031 exchange that and buy something here and not have to pay any gain on that purchase, at least yet. So, okay, so we had a question about the 2 out of the past 5-year exemption about single family homes. Now, a lot of times what happens is people will take an investment property and do a 1031 exchange and buy a lake house out here in Texas, turn it into investment property for a few years, and then move into it as a primary residence. Then we fall under what's called the 2 out of the past 5-year exemption. What happens is that when you buy a primary residence, as long as you live there for 2 years, any gain that you have on the property is tax-free, up to $250,000 for single, up to $500,000 if you're married. And so this is kind of a way for you can take an investment property, turn it into a primary residence, and move into it sometime down the line, right there in the beautiful shores of Lake Travis, because you've done an exchange for maybe an apartment building or a single family or a land in California and bought of equal or greater value out here, and then you move into it. When you go to sell it someday, if you ever do, you have that exemption in place, which will shelter that exchange. It will shelter that taxable income, that taxable expense that you would have had. So buy your retirement home now and move into it later. And that way you can eliminate your capital gains on the property when you sell it. So you can also eliminate capital gains by becoming a real estate gypsy. I like that for the younger crowd. We have some younger folks here. We talked a little bit about that. Buy a house, owner occupied with 0 or 3.5% down financing with Mark Hairston. Move into it, live there for a year, and then go buy another one saying this house is a little too small for me. I want to go buy another one, rent that current house out, and move into the next one and live there for a couple of years or a year, and then go buy another one. So within a 24-month period, you could actually buy 3 properties, 1 owner occupied, 2 investment properties, and have 3 properties all done with pretty much owner occupied financing at the
Right.
lowest rates.
As long as you're moving up.
Yeah, and there's rules. I mean, you can't, there's rules on how to do that, but we show you how to do that.
Sure.
And that's where we talk about, we talk about where it's a great business for people to buy with their kids or buy in with their kids. We had in the book that I wrote, we have the psychology, I call it Psyched Up for Selling. We had 2 psychology UT students. They were working as busboys, but they qualified with their parents on an FHA loan, purchased the property for about $100,000. It was a 4-bedroom house. They leased the 2 other bedrooms out. They were able to qualify because the FHA allows parents to qualify and not necessarily live in the property and combine their incomes. They moved into it. They rented the 2 other rooms out to roommates, which covered their house payment. So all with buying a home for their college education, they were able to live there tax-free. They became investors and they established credit. And now they've got a great investment property, or they could sell it after they're done with their 4 years. So it's a pretty exciting thing. We also talk about, this is a great thing, for some of my clients in California, a guy works at Cisco Systems. He just had his first child. He's planning another one, and him and his wife decided to buy an investment property here and put it on a 15-year loan so it could be paid off by the time the child is entering into college. Now you think about that. Right now with a 15-year loan, it's about break even.
Yes.
But if we notice the chart in the Austin, Texas, we're seeing about doubling of values, depending on where we're at in the cycles, about every 15, 18 years.
Right.
So he bought a $150,000 property. How much should that home be worth if everything plays out the way it's been going for the last 30 years? Should be worth about $300,000. And the tenants paid the mortgage off over that period of time. And now they've got a $300,000 asset they could sell, and it would pay for not only his education, but probably his little sister's education as well. And it didn't cost him anything because he pretty much break even all the way through because of the 15-year mortgage. We do the same thing with the single-family retirement strategy that my friend Ron Sudman has put together a software program that allows you to plug these homes in and run different scenarios. But it sets it out as why am I buying all these investment properties? And it's really because you want to be able to be at the end of your time and ready to retire. And what do you have? 5 properties? What kind of cash flow are you going to have? You have 10 properties? How much cash flow are you going to have? So it's a way to look at it to augment your current retirement strategy. One of the things we've been having a lot of questions about is using a self-directed IRA and even a self-directed IRA LLC. And we don't really have time. What time have you got, Daniel? 12:34. Boy, we're cranking right through this. Is to use your self-directed IRA to purchase properties, and there's specific ways to do it. And that way you can purchase a property and the income and the expenses are held in the IRA so that you then defer. If you have, let's say you pay cash for it, you're going to have positive cash flow in that IRA. Well, it all falls under the IRA rules. And as long as you follow the rules and don't use it for your own purposes and you don't commingle funds, you can now use your self-directed IRA to buy real estate. And you can even use what's called a self-directed IRA LLC, limited liability company, which allows you to actually have a checkbook that's still held within the IRA and be able to buy property or put down payments or whatever it is, buy whatever you want through your self-directed IRA without having to go back to the custodian every time that you want to make a transaction happen. So there's very specific ways that you want to be able to do that. But the great thing about that is you can, like one of my friends in Irvine right now has an IRA because he had a 401k when he moved to his new company. That now became a self-directed or an IRA that he could use for investing, and all the income will be tax deferred just like any other investment in real estate. So you have to hire a custodian, and there are several companies that you can use for these custodians to be able to use your money as a self-directed IRA. Must follow the IRS rules, or you can end up paying capital gains and penalties and all kinds of stuff. So you need to consult with the experts. So what we try to do is buy popular homes in popular areas, single family, multifamily, distressed properties, foreclosures, REOs, short sales. We do it all. You can even start searching for homes on austinreos.com is a website we've set up for looking for those. Let me talk a little bit about distressed properties here in Austin. We don't see as many, we're not in a place where we have a lot of foreclosures. We still have our share. And we try to not work with too much of the short sales, because short sales have a really no way you can know if you're going to be able to purchase a property. We do still sell short sales, but we ask you to go ahead and make an offer, and then it sits at the bank for a couple months, and we keep moving on until we find a property that actually works for you. And maybe the short sale will come through, and maybe it won't. REOs we do like working with. Those are real estate owned. They're already owned by the bank. So we see Fannie Mae, Freddie Mac foreclosures owned by the government, and that's nice to deal with Fannie Mae and Freddie Mac foreclosures because you actually have a department that you can work with that actually can get answers to your questions and actually get the thing moving and you actually buy something. We also like model sale leasebacks, but they're far and few between, where the builder will lease the model home back, and pre-leased homes, those turnkey investments like I talked about earlier, where we already have tenants in place, management in place, everything's up to the Texas property code. It's just a matter of change of ownership, and no leasing fee, no vacancy time, and you get to collect the rents and the security deposits up front, and you usually don't have a payment for 30 to 60 days. Pre-leased homes are a great way to go to get started. Okay, so your pro team. I'm responsible for setting up this on this side, which is your real estate broker, your lender, referring lenders like Mark Hairston. You'd be your property manager, get your the proper property management in place, and then your leasing agent. This is your responsibility, and I can help you with it if you don't have them, but the bottom line is you need a CPA, someone to help you with financial planning, an attorney. If you're going to do LLCs, you need that, and if you're going to be doing self-directed IRAs, you need a custodian. These are some of the things that you're going to have to set up if you're going to do to be able to have wise counsel. This is something that's out of the Millionaire Real Estate Investor, which I'll be teaching next month, starting on the 10-week webinar series, which is right here. We'll be teaching out of this. This is one of the pages on 159 is your Millionaire Real Estate Investment Circle. I know it's hard to read, but I'll send you this PowerPoint. But bottom line is that you have to have a support circle. You start with your Millionaire Real Estate Investor in the middle, and then we have consultants, mentors, partners, and these are all people that you know, like, and trust that have the expertise, and they put together your support circle, which is real estate agents, lenders, attorneys, property managers, and contractors. We all help you with these. And in case they also have all these other people that you need under your service circle, most real estate brokers don't have this system set up in place, but we do, because we work with a lot of investors. Now, this is something that we help put together for you so that you have a team. I use the acronym for team as trusted experts, advisors, and mentors. So that's the book I'm going to be teaching out of. Many people have done this. There's interviews with all kinds of multimillionaires that have started out just like you and me in real estate. So I'm going to help you find the property management, and so you can help you get these properties leased and stay leased and preserve it. We like people to stay for a long period. We're seeing people stay for usually about an average of about 3 years, right, George? About the tenants, about 3 years. So people aren't moving. They used to move. If you raise the rent $50, they'd be like, I'm moving. Well, they realize now they're smarter than a lot of us landlords. They're going to raise the rent $50. Well, if you go somewhere else, it's $100 more for the new rent. So they're staying or they're buying. I don't recommend that you self-manage. So, Renner team at Keller Williams, my job is to help you. I'm seeking long-term relationships, to help you buy property, search for and find it, act as your eyes and ears, tie it up, negotiate it, do the walkthroughs, arrange for leasing and financing, and then somewhere down the line, a disposition when you decide to sell it or exchange it for more. So the plan of action here is contact me. We got all my contact information. Anybody here doesn't have it, it's ken@buyaustin.com or 512-423-5626. We'll discuss your plans, your dreams, your aspirations, how you want to do it in real estate. Then we'll get you hooked up with the lender to do the application, and then we'll move down the road to find you the best property that's going to work for you. So make plans to visit if you're out of state. Make plans to visit Texas. Everybody that's here who wants to be an investor, we know where to go. I'll help you with it. We'll dive in and find you a house. Find you a couple houses. Okay, so the best compliment a professional can have is a referral from a satisfied client. So my job is to work my way into being your trusted advisor to the point where you throw the rope out to the other people and let me be your trusted referral agent and somebody that can help you through this process now and on into the future. So, once again, investorcrashcourse.com. This is what I'm going to be teaching out of next month, just so I can show you. This is one of the things that Gary Keller is a multimillionaire. Actually, he runs $1 billion company, Keller Williams International, which is centered out of Austin, Texas, but is now an international real estate company. He took he interviewed millionaires after millionaires in real estate from around the country and created this book, along with my friend Jay Papasan and Dave Jenks, to be a guide to be able to purchase property. The next in the series was this book here, which is called Flip. Okay, I'll be teaching out of this as well, and that starts next month, and I'm giving you an opportunity to join that. And then also Hold, which just came out. It's already a bestseller, and I haven't even got my copies of it. Mark and I got 50 copies to give out to our clients. And then you'll get this book, my Home Buying Secrets book, and my Power Goals book. It's a 10-week course that I'm going to be teaching starting November 7th. It's a webinar-based series. But we're going to teach some of the proven models here of the difference between big hat and no cattle, meaning a consumption lifestyle as opposed to a capital lifestyle, and building capital and building cash flow and building more cash. And this chart works pretty good with, let me go up here real quick, is one of Gary's favorite charts, is the difference is how the financially wealthy make money. Using their income, they use their cash to invest in capital, which can be real estate, can be stocks and bonds, whatever creates cash flow, and then puts the cash flow back in, and then buys more capital, more properties, and then and gets more cash flow, and then puts it back in, and then their consumption comes out. The financially insecure situations, your income comes in, you don't invest in any capital, any residential property, whatever it is, and then consumption goes out. So you'll never get rich doing this particular scenario where it's more of a consumption type of situation. Now with real estate, this is what we'll be talking about in depth over the 10-week course, is how market values add up. You start out with you buy it right, and you put your down payment. So you've got equities, not only the buying it right, your discount that you get on the property, but the investment, the down payment you put in, and then the debt. But over time, the value, according to the charts, is going to go up, and the equity therefore builds, and the debt gets paid down. And guess who pays the debt off? The tenants, the landlord. You know, you may have negative cash flow, you may have positive cash flow, but for the most part, most of that payment is made by the tenant. And market value continues to go up, and eventually the debt is paid off. Now, what I suggest that you do is if you're starting to get higher and higher rents, then take some of that rental money and put it down on the debt and pay these things off quicker. And now you have free and clear property. If you have 10 of these free and clear, and they're each paying, say, $1,500 a month, what does that add up to? $15,000 a month, right? And say figure about $5,000 to $6,000 of expenses. You're living now at $9,000 after, $9,000 a month, hopefully sheltered by that depreciation that was stored up in the property. It's a pretty good way to retire. It's been done over and over, and so that's what this model is all about. It's what's taught in here, and then you can go even further and 1031 into apartment buildings. George, you bought an apartment building, and how much did you pay for it way back when you bought it in Austin? 28 units or 23 units?
Oh, yeah.
Cougar?
Yeah, down at Stats, yeah, and sold for $880, what we bought for about, probably less than 300, I guess.
We had one,
15-year period.
it was a 170 that you paid for it, right? It got bid up to 200 or something, and then you sold it for 880?
Yeah.
Yeah, and then now what is it worth? Over $1 million.
Probably.
Okay, I wish you kept it, but yeah, so, that's one of the things, and is the same thing here, is your vacancy and expenses, as you're able to leverage this model to be able to buy it right, pay it down, and pay it off. And then whatever's left over is your cash flow. Cash flow starts off low at first, and then it builds as our rents go up, but remember, you're buying it with fixed rate financing, right? So our payments pretty much stay the same, rents go up over time, you're able to pay it off. Daniel, what time we got?
12:45.
Okay, great. All right, so this is how it works. Either you work for money, or money works for you. And if you don't get started with the passive income, you're going to end up working for money for the rest of your life. And so that's something that we're trying to help you avoid. But the great thing about it is that with minimal amount of investment in real estate, you're able to start establishing a portfolio of properties to allow you over time to live a free and clear and a financially free life. So there's that wonderful chart again. Very simple, but very powerful. All right. Okay, so in your handouts here is my investor crash course. This is what I'm going to be helping. So it's a 10-week mentorship program for real estate investors. And what it is I give you all the Real Estate Millionaire series, and flip Millionaires Real Estate Investor, flip, which is this book here, and hold, which has just come out. Don't have that one in hand, but it is coming out. It's already on its way to me, plus my Power Goals and my Home Buying Secrets, and then 10 weeks of mentorship that normally I do teaching on video marketing and goal setting and time management. I normally charge $175 per hour to have one-on-one consultation. So with all the things that I'm going to be giving you, plus the VIP membership to the Real Estate Investor Club, and then also an online software. I know you can't read that, but an online software that's by Real Estate Investment Planning, and it's a great software that builds into this model that we're talking about, the buying properties. It's a spreadsheet, an automatic spreadsheet that gives you a pro forma automatically. All that I normally charge like I said, 10 hours of my training would be about $1,750, and the real estate books alone add up to over $100. It's 1,200 pages for all this stuff. It's usually going to add up to $100 in just the books alone, along with the $80 worth of the 4 months free real estate investment property software, which is total value would be $1,927 retail, but I'm charging only $249, and that includes the $100 worth of material and 10 weeks of webinar training. And so that's would be all yours, which is very inexpensive compared to a lot of the real estate investing training courses that I've seen. Jerry, you were just at one last week. How much was it?
24,000.
Only 24,000? 24,000. What were they going to give you for that?
About what you're giving.
Yeah, my friend Jerry Caldwell here. Yeah, so really this is a 10-week training, and it's done webinar style. It's recorded, so you can always go back and look at it. But here's what it does. It allows me to help you become a real estate investor and teach you all this stuff, because remember, being an educated investor is a lot easier to work with and sell than it is to sell somebody who's not educated. The second thing is, if you buy a property from me, I'll refund the entire amount. So if you buy the property from me, that's only fair. I'll refund you all the education, and also even if I refer you to somebody who buys a property, an agent that refers. The gentleman that was just here says his wife is Japanese. He wants a Japanese speaking agent, to be able to communicate better with her. And so he said, can you help me find a Japanese agent? Well, we have 1,400 agents in the Austin area, and I'm going to help him. It'd be very easy for me to find a Spanish-speaking agent. So I'm going to refer, Japanese-speaking agent. Yeah, Spanish too. We got Spanish too. But what it is, I used to do a lot of education like this for free, and I realized no one would ever buy. So this is a way for me to educate, get paid a little bit for my time, and then when you buy or get referred, you get that money refunded automatically. So if you guys want to sign up for that, you can do that, and I'm available for that. This is the handout. It's, if you want to do it, you can pay by credit card or PayPal. I'll also send you a copy of this PowerPoint so that you have it, and if you're interested in signing up for that, it's I think you'll find a very high value, especially when you become investors. So a lot less than 24,000, Jerry.
This is a much better deal.
Mark Hairston, do you have anything to add at this point? Then come on down. We'll,
Yeah, come on down, you got any questions for financing?
Yes.
Let me ask you one thing. So this is online classes?
Yes.
Is that, what day is that?
November 7th is a Wednesday. It's
So it's at 1 PM and then?
1 p.m. recorded as a 1-hour webinar for the next 10 weeks. It's live. I do it live, and we can
So
chat.
it's every Wednesday at 1?
Every Wednesday at 1. Goes all the way into January. Starts in November, goes all the way into January.
November 7th it starts?
November 7th. It starts on a Wednesday. We call them Webinar Wednesdays because I'm also a coach for Keller Williams International, and we do webinars teaching marketing to agents. But that will be 10 weeks. But here's the thing. It's at 1 o'clock, and I know that's maybe tougher for like the folks in California. That's 11 o'clock, maybe they're working. I record them and send you a YouTube of the video of the entire presentation. And then you can review it anytime you
So
want.
if
And you can rewind it and,
Rewind it,
At
watch
one,
it.
or you can repeat it even.
You can watch it over and over. It's yours to keep. And that way you have it, and if you missed anything, or if you were out doing your job or whatever, you can go back. So they're recorded, and once again, refunded if you buy a property from me, and so it's kind of a win-win situation. So if you'd like to sign up, you can do that. I will send anybody that's been on this webcast also a link for that. I think you're gonna find it really valuable. So, Mark, do you have any questions? Do you have any?
Again, just want to thank y'all for being here. It's obvious that there's a lot of smart money moving back into real estate right now. The opportunity is phenomenal. Ken and I have both been in this a long time, and primarily because it's interest rate driven and the rates are historically low, demand's high. So whether you're buying a property to live in or a second home, we also do second home financing, or refinancing. If you have property you may want to refinance, we're here to help you as well. Take advantage of these low rates. But as an example, I wrote a loan this week for a young man and his wife. He's with Dell Computers. They're buying a condo in Round Rock. We live up here not too far from Avery Ranch. It's going to cash flow about $300 a month, and it seems like a no-brainer. So again, there's a lot of opportunity for investors and otherwise to take advantage of the market. That's how we can help you.
Yeah, I appreciate that, you guys. And so I'll be at an open house tomorrow. Anybody want to visit me? Feel free to call me. I mean, I work in the evenings, weekends. I get a lot of people thinking, wow, he seems so busy. And it's like, no, this is what we do for a living. Call me, text me, answer questions. The biggest thing is people have is questions. There's something I haven't answered that you may have in mind. So we want to answer any of those questions that you have, build a relationship, and then go help find real estate that'll work for you. And so in Avery Ranch, if you know where it is, Palmer Lane, just past 45 and 620, and make a left on Avery Ranch Boulevard where there's it's CVS, Walgreens, and all that. Left on Avery Ranch Boulevard, and then second right. Just go down that street, you'll see my open houses. Linda will be at the other open house on the other side of Avery Ranch. And so she's also one of our showing assistants, and we'd love to shake hands, talk business, yeah.
I have a question. All of these stuff that I read, these REOs, is there a surplus that the banks are holding on to protect the market?
Good question. The question was, is there shadow inventory is what it's called out there, which is the banks holding back the homes from going to foreclosure. They have an inventory of backlog that they're not flooding the market with because of the potential that would depress values. And the answer is yes and no. I mean, the answer is that there are certain areas of the country that had huge amount of foreclosures. One would be like, say, the Inland Empire in California. And let me say another area that did just until 6 months ago would be Phoenix, Arizona. And what happened is that their market flipped around so quick, it went up as much as some of the homes in that area have gone up 30% because of they were so far down in value, they kind of springboarded back up. But the shadow inventory banks holding those back up is not an issue in Austin, Texas, because we have a strong enough resale market with it being a buyer headed towards seller's market that they'll just put the property with a good realtor, get the property sold. And so there's not a big shadow inventory in the Austin, Texas region. Now, one of the things that we do like is REOs, buying REOs, and we watch those. Because Fannie Mae and Freddie Mac from time to time these REOs are real estate owned by the banks or the federal government. We'll see those after 30 days, and then you know what they're pricing them? They're pricing them at market. Which is really strange to me because it's like, you think REO, real estate, foreclosure, I should get a good deal. They price it at market. But over time, every 30 days, they lower that price, sometimes substantially. So we keep an eye on those REOs because if they haven't sold, then boom, they'll drop their prices every 30 days. And that's when sometimes you can get a good deal on those properties as well. So, any other questions? Yes?
Okay, and part of this class, you meant the membership to the reinvestor club?
Yeah.
Now, is that, that part you were talking about where you already have all these people that we need to have access to?
Yes.
Is that part of this?
Yes. Well, that's part of the question is that as part of the investor crash course, do I have access to all those real estate people that everybody involved in those circles of service? But yeah, I do that regardless. That's part of my job is to put together all those things. For instance, George and I, we own a lot of investment. He's my father-in-law, by the way. We own a lot of investment property. So we already have property managers. We have the plumber. We already have the AC guy. We have, but then there's a legal problem. We do have great attorneys. We have, we have the lenders, and we have, so this is a team that we had to put together.
That's worth a lot of money right there.
Yeah, well, it's the network, and the training really, I could do a lot better as far as, the training is really just a way for people to be a little more committed. Here's why, because when I do a presentation like this, you may not be interested in buying an investment property today, but when it starts warming up to you and you start getting educated about the process and the program, you're like, wow, that's a really cheap education. Plus I get all these books and that are proven. And then if I actually step forward and buy a property, and get out of that potential buyer's remorse mode, or actually buy an investment property, you get to keep everything, and then you get your money back. So it's a win-win.
Okay, and you have that support.
And you have support from me.
That's
Team.
It's a team. The network of support. Network of
I
folks.
would have to go get that if I was doing it on my own.
Mm-hmm.
And you've already done that legwork.
Right. Right.
that's
Yeah, we put together that support circle so that you don't have to do that. And I'll tell you, most of my competitors don't have
Right.
the support circle
I've
because it's
never
not
heard anybody had all those.
what they do. All right.
I want to ask you a question.
Yes.
My husband and I live in the village of the Arboretum, it's
Uh-huh.
a retirement community.
Yes.
It's a resort, you said.
We moved
So we
out of
live in a
our-
resort.
You said it's a resort.
Yeah, it's like a resort. We moved out of our house in Westlake.
Yes.
And we've been renting it now for 2.5 years.
Yes.
But that 5-year thing, that means we have to sell that house.
I can help you with that.
Yeah, I know you can, I just wondered, we do have to abide by that, right?
Okay, the question is that you moved out of your primary residence
Right.
that you'd lived in for a long time,
Right.
more than 2 years, which is the
Yes.
IRS rule, and you've now been out for almost 3 years.
Right.
You can get your taxable gain avoided as long as you close that house within 36 months of when you moved out of that house. After that, it then falls into the investment property category, which then would be to defer taxes, you'd have to do an exchange and buy more property, vehicle, or greater value. So it could be a huge benefit for you. I imagine it sounds to me like you've owned the house for a long period of time.
Right.
So do you own it free and clear?
Yes.
Okay, and you've had a lot of gain. So take whatever gain from whatever your CPA says your basis, whatever that gain is in that property, your CPA says, he's gonna tell you that you're gonna have 15% you're gonna pay to the government.
Forget it, we've got to sell it.
Now, here's the thing that's great about that, is that you have a very good motivation to sell, but you can price it such that it's the most competitive home in the market because you know you have a motivation. In other words, you could drop it 5% and still be way ahead. I'm not saying you do that. I want you to get the most money out of the property. That's my job. The bottom line is that if you don't sell it, you're probably subject to the capital gains. Check with your CPA. But here's another thing. If you move back into it for 2 more years, you start the clock all over again.
We're never going to do that.
All right. Well, I can help
We
you with
don't
that.
ever want to move, we're going to go to heaven.
Well, you're going the right
Amen.
direction. You're going the right direction. All right. Well, thank you guys. Any more questions?
We'll be hanging around.
Yeah, we'll be around. Thank you so much. What's your name?
Vivian Spence.
Vivian, thanks.
Vivian.
Thanks, everybody.
Thanks, Steve. Thank you, guys. Appreciate it. Yeah, we'll be around talking. I would love to talk with you
I
guys.
just wish